What is the actual graduation day? 15th or something? 14th, 13th? But I want to get as much out of you as I can in the next 4 weeks. So this actually is not that complex a project. What you will see is this gigantic Excel spreadsheet, right? The only thing I would suggest you not do is try to use everything in the spreadsheet. There are like 200 columns. Obviously, you can't use all 200, but I've kind of thrown in everything but the kitchen sink in there in case you might want to use it, okay? So if you look at the basic structure of the project, there are 250 companies there. They're the 250 largest market cap companies in the US and Europe. I thought about throwing in emerging market companies in there, but that adds a layer of country risk, and that would have required more information than I felt comfortable delivering on that spreadsheet. So it's large US and European companies. I have tried to make life simple for you by looking at only companies that make money. So you have no GMs on the list. Obviously, it wouldn't be in the top 250 market cap companies anyway, hey? But no money losers in there. There are relatively few financial service companies. Usually there'd be more if you printed off the top 250 a year ago. There are a few financial service companies that are in there, that's fine. Okay? You have to tell me which 5, or this is your basic task. Whatever you decide to do, it's going to be a relative valuation. So don't even start off saying, I'm going to do it if you want to. Actually, I won't stop you doing 250 discounted cash flow valuations, but my suggestion is stick with multiples and comparables. Here's where you get discretion. You can pick any multiple you want. Price earnings, PEG ratios, price to book, price to sales. You have to control for the variables that drive that multiple, which by now shouldn't be rocket science. So whatever you pick, control for that. Tell me which 5 stocks you'd pick as the most undervalued, which 5 most overvalued. When I get all your lists back, I will regurgitate the list back. So these are the companies that came out as most undervalued, most, so we'll see what companies come through and whether there's commonality, because my guess is you'll be using 25, 30 different multiples. Hey, if you want to invent your own multiple, be my guest. Hey, but just be careful that you then do the algebra to kind of figure out what drives that multiple. Lewis? Just, you ask me, can you use a composite of several multiples? Fine. If you want to use 3 multiples, but then figure out a way in which you're going to create a composite, because ultimately what I want is 5. So I don't want 3 lists of 5. So if you use a composite, 3 different multiples, I still want your 5 most undervalued companies, which means you got to figure out a way to take the 3 different multiples and make them sing a common tune, which means you got to weight the multiples. Here's the second part of your task. I said pick the one company out of this 250 that you would take through a restructuring deal. You're a KKR, you're a Blackstone, you're going to take this company private, you're going to restructure. So you're going to be asking different questions about what that company should look like than the 5 most undervalued, overvalued are acting like a passive investor. You've got to take it as a given. Whatever they do, they do. But in the second part, you can say, I'm going to pick the company, I can change the company. So you're looking for potentially different things in the second part than you did in the first, but there are only one. It might be one of your 5 most undervalued, it might not be. So it's your choice. Okay? So try it out, because it's actually a great exercise if you're going to go into portfolio management, private equity. I mean, this is going to be the rest of your life. You have to screen large portfolios to figure, or even as an individual investor, right? You're trying to decide which 5 stocks out of these 500 should I pick. This will give you a chance to kind of get your hands dirty doing it. It will require that you use either Minitab, or as I said, if you have access to SPSS or SAS or some other statistics package, go ahead and use it, because there's only so much eyeballing of the data you can do with 250 companies. You will also notice that I haven't computed any of the multiples for you. So I've given you the market cap, earnings per share, price. You're saying, well, why? Because I want you to decide how you're going to compute the multiple. You decide whether you want to use price divided by earnings per share, or market cap divided by net income, trailing 12 months, forward earnings, whatever you want to do, make your decision, but then check for all the things we've talked about preserving internal consistency. Okay? Any questions? So actually I was going to say, I was just told that because you have a lot of Jewish holidays between now and 2 weeks from now, that Monday might be a little tricky. So I'm willing to move it to Wednesday. I don't know how much that helps, but we can move it to Wednesday. So the actual due date is not going to be the 20th. It's going to be the 22nd. Okay, so you have an extra 2 days. But if you get done early, all the better. Just send it to me. But if you have the extra 2 days. Other thing is your final exam is scheduled, I think, for what, the 7th, the 11th or something, right? The 11th. There will be an early final the Tuesday after the last class. Last class is, I think, the 4th. There will be an early final on the 5th. And I can't give the final before the last class. It just doesn't gel. But there will be an early final on the 5th. I will send out an announcement of what room it's going to be in. You have the option. You have until the very last moment to decide, but I need to get a sense at least of whether 10 people are going to be taking it or 80 people are going to be taking it for an obvious reason. I have to figure out how big a classroom. So if you have already decided you're going to take it early, let me know. So if I get 30 people saying I've picked it, I'll look for a classroom which fits 70 or 80. If only 7 people say I'm going to take it early, then I'll look for a smaller room because it's kind of tough to get classrooms that week because the finals week, right? So the early final will be May 5th. Which actually shouldn't conflict with any other finals because finals actually officially don't start till Wednesday. I'm actually breaking a school rule. But since I break school rules all the time, I really don't care, right? So I'm not supposed to give an early final. I'm not supposed to do all kinds of things, but who cares, right? So in this case, I know there are people who are in exchange programs who need the grades in early, who need to travel. So if you have a flight you've already booked on the 7th, you want to get out of here, no, the 5th is your choice. Get it done with and get out of the way. Okay? The only thing I can't promise you is that the May 5th final and the May 12th final or the May 11th final will be of equivalent. So I don't want anybody coming to me afterwards and say, I took the 5th final, I looked at the 11th final, it was a lot easier. Or, I'm going to write 2 different finals. So one might be easier, one might be more difficult. I don't know which one's going to be which up front. And obviously I won't tell you. Malik. 22nd. My mystery project is the 22nd.
And what time is the early final?
I don't know yet. It won't be early. It won't be early as in 8 o'clock, right? I mean, I don't show up until 9:30 to begin with, so that starts off the clock. So it'll be probably 10 to 12. I prefer to get it done before lunch. It's a 2-hour final, right? So it's got to be 10 to 12 or somewhere around there, depending on when I can get the room. I'm hoping for 10 to 12. Is something else going on, mate? They have finals for negotiation. Why don't you just negotiate with the person who's for the final? That would be okay. Never mind. You know what? How many people are in the negotiation? Okay. You know what? I'll check because I'm flexible. I don't care. I'll do 1 to 3. But then 1 to 3 creates a problem for anybody else? No. You know what? I'll send 3 slots. If I get no no's on any one slot, I'm going to pick that slot. Okay. Let's try that. Yes. You have a what final?
Negotiation.
Yeah, that's what I said. So, right, so we'll try for the afternoon then. Right. That's a 3-hour final? Okay. Any other questions? Last piece of news, I put packet 3 up to download. There is a packet 3. Right? That's a scary thought, right? We're going to actually be done with this packet in about 4 sessions. Right? So there'll be 5 sessions for the last packet. So download it when you get a chance. It's a smaller packet or shorter packet than the rest. It's the last rump end of the class, acquisition valuation, value enhancement, and real options. Okay? That's about it. Let's pick up off then on Wednesday. We're talking about EV to EBITDA multiples, right? I set up that equation for the EV to EBITDA multiple. Today I'm going to start off doing what we did with PE, PEG ratios, etc. I'm going to take a hypothetical company. Here's what this company looks like. It has a tax rate of 36%. CapEx as a percentage of EBITDA is 30%. I'm going to state everything in terms of EBITDA because it makes my life a little easier. Depreciation as a percentage of EBITDA is 20%. Cost of capital is 10%. For simplicity, let's assume this company has no working capital needs. So there's no change in working capital to worry about. Firm is in stable growth, expected to grow 5% a year forever. So you've got all the inputs you need to compute at least the intrinsic EV to EBITDA multiple. Is everybody clear what I mean when I say intrinsic PE? I'm using that discounted cash flow model to get it. That's not a relative valuation. I'm actually using a dividend discount model to actually estimate. Here I'm actually using a free cash flow to the firm model to estimate what the EV to EBITDA should be. So with these characteristics, this is what the numbers look like. 36% tax rate. So that's the first term in the equation. 20% is depreciation. 30% is CapEx. Change in working capital is 0. This firm, given the characteristics I've described for it, should trade at about 8.24 times EBITDA. I know that's beyond above that rule of thumb, right? 6 times EBITDA is cheap, but we don't care. This is a fair multiple of EBITDA for this company. But again, with these hypothetical companies, it's not the number you get that's interesting. It's what happens when you change the inputs, right? It allows us to change one input at a time. Let's start with 3 inputs here. Let's start with the tax rate. I used a 36% tax rate, right? If that tax rate were made 40 or 50%, the EV to EBITDA for this company, holding all else constant, will drop off. If that tax rate was 0%, it's going to show up. This is why I said last week, when you're comparing Deutsche Telekom to Irish Telecom, you should expect Irish Telecom to trade at a much higher multiple of EBITDA because there's nothing going out of in terms of taxes. So that's the first. So remember again, the reason we do this is to get our ducks lined up. So if I come to you and say EV to EBITDA for this company is low, first question you're going to ask me is what's the tax rate? Maybe you have an 80% tax rate and you didn't know, right? Second thing I looked at was the net capex. Remember, I'm keeping growth fixed, and I said, what if I had to reinvest more to get the same growth rate? No surprises here. The more my net capex is, the more I have to reinvest to get the same growth, the lower the EV to EBITDA has to be. Which actually can be framed differently. If I keep growth fixed and I change the reinvestment, I'm in effect changing the return on capital, right? So as my return on capital goes up, my EV to EBITDA increases with it. You're saying I've looked at 3 different potential here, 10%, 9%, 8% cost of capital. So holding else constant, the more I earn on my projects, the higher my return on capital, the higher the EV to EBITDA. If there is a story that embeds everything we've done in this class, it's that value for a company should be a function of what you earn over and above your cost of capital, excess returns. I mean, that's how we frame DCF valuation. It shows up in EV to EBITDA multiples as well. So when you want a company that's cheap on an EV to EBITDA basis, you want a low EV to EBITDA, you want a low tax rate, you want a high return on capital, and a low reinvestment rate. And if you have a cost of capital issue, you want a low cost of capital as well. In other words, you want to keep all those other variables working in your favor while you look for low EV to EBITDA. So let's try an experiment. Right? I am the trucking analyst, and this is my sector. It's almost impossible to read that table, so don't even try. I'm going to put out a buy recommendation on one of the companies, and I'd like you to ask me questions about this company. So you're a potential investor. I'm trying to get you to buy one of the companies. The company I really like on this list is Ryder Systems. Now you've all seen the Ryder trucks, right? You rent the trucks to move your stuff around. So it's a big brand name. And the reason I like the Ryder Systems is the EV to EBITDA for the company is 2.81. It's about half the EV to EBITDA for the entire sector. So basically picking the company because it trades at a low multiple of EBITDA. So go ahead. What's the first question you're going to ask me? What's the tax rate? They're all about the US companies. They're all money-making companies. The tax rates are all roughly 30, 35. So the effective tax rates, if you look across these companies, look about the same. So you can cross that off your list. What's next? What's the return on capital? They're all mature companies. They earn about 8.5%, 9% return on capital. There's no 30% return on capital. There's no 3% return on capital. You can cross that off your list. Right, this is looking good, right? What's the third question? What's the what? You could ask me what the cost of capital is, but they're all mature companies, all use debt. Cost of capital is the same, which leaves us with just the reinvestment rate, right? And here there's a little quirk in this particular sector that I've got to kind of give you some details on. The way this sector reinvests is you have fleets, and you replace your entire fleet every 4, 5, 6 years. Rather than replace it on an annual basis, they replace it. The reason they do it is they get a bulk discount when they go to GM or a Ford and say, I'm going to replace my entire fleet. So they can go 4 years with no capex, and the 5th year they have huge capex. 4 years with no capex, 5th year they... So reframe that question. Rather than ask me what the reinvestment rate is for Ryder, what would you like to know? When did they last replace their fleet, right? 4.93 years ago. And usually they replace their fleet every 5 years. See what's going to happen here? You buy this company at 2.8 times EBITDA, you think you got a bargain, right? 2 weeks from now, you're going to open up the Wall Street Journal. What are you going to see? Announcement saying Ryder System raises $3 billion in new debt to buy a new fleet. There goes your EV to EBITDA. I actually pulled this off a real equity research report. There was a buy on the stock, and what made it almost tragic was the life of the fleet is actually public information. You can go to the 10Ks for each of these companies and look up the life. All this analyst had to do was add a last column, and the number would have jumped out of it. Maybe you would still have recommended Ryder after looking at that life, But he didn't even try. That's why I said with relative valuation, my problem is not that equity research analysts use multiples. They're so sloppy about asking the follow-up questions, dotting their I's and crossing their T's before they say buy or sell based on a multiple. So next time you pick up an equity research report based on EV to EBITDA multiples, take a look. Take a look at that buy recommendation, ask the questions. It's amazing how many buy recommendations you can start crossing off the list because they fail 1, 2, or even all 3 tests. Okay? Most companies that trade at abysmal EV to EBITDA multiples deserve to trade at abysmal EV to EBITDA multiples. They have terrible returns on capital, huge reinvestment rates, and people wonder why they trade at 2.5 times EBITDA. Any questions on EV to EBITDA? Yes, Luis.
Don't you have in this industry a lot of leases?
Well, it depends. It really depends. It depends. There's actually a lot of variation across companies here. It's not like retailing where everybody has an operating lease, okay? Because of the nature of the product. See, in real estate, in retailing, because what you're leasing is real estate, it's much easier to qualify as an operating lease. Here, if you have a truck that you're running into the ground, you don't qualify easily for an operating, because you have to have a residual value and ownership rights at the end, which are in fact substantial enough that you can qualify. It's much more difficult to qualify for operating leases with trucking than it is with real estate or with real estate-based leases. So you actually get a lot of variation here. You actually see traditional debt actually show up. But even if you didn't, to do EV to EBITDA, if you asked me to compute EV to EBITDA for a retailer, I would take the present value of leases and treat them as part of debt, right? Yeah, and an EBITDA multiple, exactly. Because otherwise it's not fair, because some retailers buy, some retailers lease. You're comparing apples and oranges otherwise. Okay? Any other questions? Yes.
So basically the adjustment that we have to make in this case would be to find out the capex for the year which was made and divide it by the useful life.
And you'd have to also see how imminent it is, right? Because in a sense, if you're just ahead of a reinvestment, your enterprise value is going to be low because the market knows essentially there's a reinvestment coming, so it's marking down your market value to reflect that reinvestment. So in about 2 weeks, when you compute the EV to EBITDA for Ryder, guess what? It's going to go from 2.81 up to 4.81, right? That additional. So that's, I think, what we're missing is that timing issue here. So even if you don't explicitly adjust the multiple, at least you can control for the difference in lives, because what you want then in this sector is low EV to EBITDA with a new fleet. Right? Because then you've already paid for it. You have 4 more years of riding off that fleet with a new fleet, a decent return on capital and a decent cost of capital. Okay? So that's effectively all we require. Is we don't need a quantitative adjustment, even a qualitative adjustment. Something where you've asked the question and said, I've dealt with that, is often sufficient. So when you see Ryder looking cheap, there's the reason for it looking cheap. Big reinvestment coming down the pike, that's what's keeping the EV low. And when that happens, undervaluation is going to dissipate. So when you look at EV to EBITDA multiples and you look at why they vary across sectors, here are some of the things you have to control for. The capital intensity really matters. It affects both the DAR, the depreciation component, and it affects the enterprise value. Your cost of capital matters. We're comparing EV to EBITDA for steel companies globally. You should expect to see emerging market steel companies trade at lower EV to EBITDA multiples than developed market steel companies. And it also depends on your growth and how efficiently you deliver the growth. So don't just look at the growth rate and be dazzled by it. Look at how that growth is being delivered. So basically, you're looking for both growth rates and efficiency of growth as measured by the return on capital. Let's close the process. As with all of the other multiples, we've defined, we've described, we've analyzed, we've applied in a sector. Let's expand to the market. Okay? Does anybody remember what the R squared for the PE ratio regression was? We didn't like it. We thought it was low. I think it was 28%. Okay? EV to EBITDA multiples, I do even worse. That's actually unusual. In most years, when I run these regressions, the EV to EBITDA multiple regression has a higher R squared than PE ratio. But in January 2009, at least, that's all you find. Which actually is something this is actually a kind of warning signal I'm sending you on the mystery project, which is don't expect to go in expecting to see a particular number, because the data is the data. It might sing a different tune. You might throw in a variable that's saying that should matter, and the data might scream back at you. It doesn't. Don't fight the data. Don't sit there saying it has to work. Something must be wrong with my regression, because sometimes regressions work, sometimes they don't. They take relative valuation to the nth degree and reflect what's happening out there. Okay? Here are the variables I used in my EV to EBITDA regression. I used the growth in revenues. Notice the subtle change. Up till now, when we ran the regression for PE ratio and PEG ratio, I used growth in earnings per share, right? Here I'm using growth in revenues. Why am I using growth in revenues? Because it's a firm multiple, right? In fact, I look for growth in operating income. Unfortunately, that was missing for a lot of companies. I was able to get growth in revenues or growth in earnings per share. So I used growth in revenues because it seemed to me much closer to looking at the firm value, enterprise value, than growth in earnings per share. I used the effective tax rate. Why? Because tax rate should matter for EBITDA multiples. I used debt to capital as my proxy for risk. You're saying, why didn't you use beta? Because beta captures equity risk, and I'm looking at the entire firm. If I were desperate, I might throw in some other proxy for risk, but this seemed to be something that captured the risk measure pretty well. And I threw in the reinvestment rate. The one variable where I was a little dicey is you look at the T statistics, the reinvestment rate is actually a little below the threshold, the 2 threshold that we normally use, but it's still high enough that I left it in there. If the T statistic on that had been 0.5 or 0.3, I'd have been tempted to take it out of the regression, because why add noise to your regression? I know you want to throw in all the variables in, but if a variable just adds noise, it has no significance, might as well take it out. Okay? So when you run the mystery project regressions, you take PE against growth, beta, and the payout ratio, because those are the 3 that should matter. If one of those variables is not statistically significant, rather than leave it in the regression, just take it out. Don't throw in a variable just because it should be in there. Okay? Any questions? Expanding out into the other markets, basically you see the numbers, R squareds are uniformly abysmal across the markets. In fact, Japan had the highest R squared for EV to EBITDA, 33%, 13% in Europe, 19% in emerging markets. I tried to throw in the same variables, but you can already see in Europe, neither the reinvestment rate nor neither the reinvestment rate nor return on capital actually even showed up as statistically significant, so it's disappeared. So the reason you see different variables in different markets, and some of the variables it didn't work, so it just took it out of there because the T statistics were not significant. Okay? So those are the earnings multiples: PE ratio, PEG ratio, EV to EBITDA. And in fact, if you can understand EV to EBITDA, you can see variations: EV to EBIT, EV to after-tax EBIT. They're all very highly related to each other. Which brings me to the next set of multiples, which are book value multiples. Okay? It's actually pretty intuitive, right? The accountant tells you the value of a firm is X. The market tells you the value of the firm is Y. It does make sense to think about comparing those 2 numbers. In fact, I used to have a broker at Merrill. I've never used the guy, but he had self-appointed himself as my broker for life. I don't even know whether he's still around. I haven't heard from him in a few months. So he would call me every 6 months, and I liked hearing from him because he had the most atrocious sales pitches of any broker that I've ever heard. One of his favorite sales pitches on a stock was, "Have I got a stock for you?" He wouldn't even say who it was. "Have I got a stock for you?" And I knew it was him. Okay. And here was one of his favorite sales pitches: "The stock is cheap because it's trading at half of book value." That's it. He'd stop. And I'd say, "So?" He said, "Half of book value must mean it's cheap." And I said, "Why do you think that?" He said, "Book value is what you'd get if you sell the company." This guy had a lot more faith in accountants than I did. But what he was saying is actually not that unusual. A lot of people mistake book value for liquidation value, right? In fact, in many of your classes, if you're doing one of these distress sale valuations, it's amazing how often people take book value and assume it's liquidation value. You try that with a real company, you're going to be in for a huge shock. But if you believe that book value is actually what you would get if you sold this company today or liquidated the company today, it makes sense. Look at the price. And if a stock is trading at less than book value, then it's a bargain. Let's check it for consistency first. Numerator is market value of equity. Denominator has to be book value of equity, right? Here's what can throw you off, though. You take a company like News Corp or Viacom, which has 2 classes of stock. Be very careful. If you take the share price and multiply by the number of shares, you can try this even on Bloomberg. You'll see that the numbers don't equate to the market cap that Bloomberg reports on page 1, description for your company. The reason for that is even if the other class of stock is not traded, you should be including it in the numerator because your denominator is the book value of all of the equity in your company, not just the Class A shares or the Class B shares. So check for that consistency. So that, I think, is the key issue here when you think about what to include. We also talked about equity including options. Same thing applies here, right? So if you're running away from that options debate, remember the total market value of equity at a Cisco is market cap plus the value of equity. So you can get some strange results if you have a lot of options outstanding in a company in terms of price to book ratios. Okay? So definitionally, it's pretty straightforward.
When you've got two classes of stock and both are traded, but one is traded at a discount to the other.
You just add up you just take the discounted price because
you use the two price. You don't use the highest.
You don't use the higher price because there's a reason for the discount, right? Usually it's discounted either because it's illiquid, right? It's because it has given away some rights, voting rights, dividend rights to the others. In other words, often when you see rights given away by one class to another, the class that gave away the rights will trade at a discount. The class that got the rights will trade at a premium. If you use the premium price on both classes, you'll overvalue the company, right?
What if the discount is because of liquidity?
You would still think of it as market cap because who knows? Liquidity affects everything, right? So if you start saying, I'm going to look at the truly liquid value of equity for the company, then every stock price has to be adjusted, right? So even the Class A shares, which are liquid, there isn't a liquidity discount. It's just smaller for some classes than for others. So once you start opening that box and saying, I'm going to adjust for things that I think should be in there, and besides, if you actually buy the stock, you're going to buy it at that price. Bargain, go ahead and buy it at the bargain, right? So let's describe. Remember that price to book of 1 being cheap? Some interesting things have started to show up if you look at the price to book ratios for at least US companies in January 2009. About half of all US companies. First, out of the 7,500 companies, I lost 1,500 companies in computing price to book. With price earnings, that was obvious, right? Why did we lose it? Because the earnings per share were negative. With price to book, we lose them for exactly the same reason. The book value of equity for 20% of all US companies now is negative. And you can see how that happens, right? How does book value become negative for a company? You lose money and you keep losing money. Because every time you lose money, because your book value of equity, retained earnings gets added to it. If you have retained losses year after year, your book equity can hit 0 and keep going. Now for an accountant, this is a sign that you're on death watch. But out of the 1,500 companies, about 200 might have been in death watch. The remaining 1,300 were just growth companies. The book value of equity basically means absolutely nothing at this stage. I mean, Amazon had negative book equity in '99. Because if you are a growth company, it's very easy to hit that negative book. But I lost about 1,500. Of the 6,000 companies for which I was able to compute price to book, roughly 3,000 companies traded a price to book less than 1. This again is a new one because last year's median price to book ratio was about 1.7. This year the median price to book ratio for US stocks is 1. Anybody who's sticking with that old rule of thumb, stocks trading at less than a price to book of 1 is cheap, will have lots of potential bargains out there. My suggestion to my broker would have been, hey, if you think US stocks are cheap, maybe you should be looking at emerging market or Japanese stocks. Look at the median price to book ratios outside the US. In emerging markets, the median price to book ratio is now 0.91. In Japan, the median price to book ratio is now 0.75. Actually, there's one reason why price to book ratios vary across markets is because of accounting differences. Japan actually, a lot more stuff shows up in book equity than in the US, okay? Because they're allowed to put provisions in. Essentially, they can inflate book equity. Taxes also play a role in what happens in book equity. Okay? This morning in corporate finance, we were talking about the capital structure decision. I know whether you remember the trade-off, tax benefits versus, and how interest is tax deductible, but cash flows to equity are not, and that's actually the case in the US. But then I brought up the example of Brazil, where equity actually provides you a tax advantage because in Brazil you're allowed to claim an item called interest on capital, which is the book equity multiplied by whatever rate the government supplies as the rate you can use for interest. So this year, for instance, the number is 12%. So this year you can take your book equity, if you're a Brazilian company, multiply it by 12% and claim it as a tax reduction. That's the law. It's carried over from the days of inflation where they wanted to kind of keep your taxes going with your inflation rate. Let me ask you a question. If that is the tax law, that you're going to be allowed to take book equity and multiply by 12% and subtract it to get to taxes, As a Brazilian company, do you see what your incentives are going to be when it comes to book equity? You want the book equity to be as high a number as possible. Brazilian companies are notorious for stuffing everything they can into book equity, which is part of the reason. If you look at price to book ratios in Brazil, when you compare a Brazilian company in a sector with all the other companies in other markets, you'll often find the Brazilian company has the lowest price to book. Not because it's a bad company, but because the tax laws kind of skew the numbers. So if you see a market where price to book ratios look abnormally low, check out the accounting and the tax rules. Maybe there is a good reason why the numbers are what they are. But again, all these numbers today are much lower. They're half what they used to be in some markets a year ago, reflecting what we found with price earnings, EV to EBITDA, all the other multiples. So, and the other thing is clearly we talked about the asymmetric distribution, peak to the left, tail to the right, price to book is a very asymmetric distribution. The median is 1, but there are stocks out there that trade at 20 times book value, 25 times, 30 times book value, especially growth companies, technology companies, where that's going to be the case. The other thing I want to mention about book value is if you trust accounting book value as you measure book value, you're going to understate the book value of technology and pharmaceutical companies, right? Why? We talked about it in the context of DCF valuation. R&D not being capitalized essentially means the book equities for these companies are understated. So if you want to make it consistent, you really should be adjusting the book value of these companies for R&D. Market cap already reflects it, so you don't have to do any adjustment for it. But the book equity should reflect the present value of R&D, or the capitalized value of R&D treated as part of book equity. Right? So define, describe, let's analyze. Right? We're back to equity multiples now. EV to EBITDA, we kind of took a tangent to firm value multiple. We're back to equity multiples. Let's go back to the simplest equity valuation model we can think of. Dividend discount model, right? Value of a stock is expected dividend next year divided by cost of equity minus the growth rate. I'm going to divide both sides of that equation by the book value. If you divide both sides by the book value, the price to book value ratio for a stable growth dividend paying firm is a function of 4 variables. The cost of equity, the growth rate, and the payout ratio. Those are exactly the 3 that showed up at PE ratio. And you see a 4th variable pop up. The 4th variable that pops up is the return on equity. In fact, at this point, I'm going to make a statement about multiples. Every multiple has a companion variable. What I mean by a companion variable is the one number that you absolutely have to know if you're going to use this multiple. Or put another way, if I'm trying to sell you something on a price to book basis, the first question you need to ask me is, what's the return on equity of the company? That's going to answer 90% of your questions. Companies with low returns on equity will trade at low price to book ratios. Companies with high returns on equity will trade at high price to book ratios. So the price to book ratio is a function of 4 variables: cost of equity, growth, payout ratio, and return equity. And the return equity is going to be the dominant variable. And I'll back up that statement. I'm going to show you statistical proof that the return equity is by far the critical variable driving price to book ratios. In fact, this equation here, remember when we did fundamental growth? I know it was way back. The growth in equity earnings per share we said was the retention ratio times the return equity, right? In fact, if I go into this equation and plug in, instead of where you see the growth rate, if I plug in the retention ratio times the return equity, I can actually simplify the price to book ratio for a company to be the following. Return on equity minus the growth rate in the numerator, cost of equity minus the growth rate in the denominator. Take a look at that. Return equity, cost of equity, right? You can already start telling me when a company should trade at book value. What has to be true about the return equity and cost of equity relationship? Companies with the return equity is equal to the cost of equity will trade at book value. Companies with the return equity is higher than the cost of equity will trade at above book value. Companies where the return equity is expected to be below the cost of equity, that it's an excess return measure, will trade at less than book value. That's actually an incredibly useful insight. When people say, well, this stock is cheap, it's trading at 0.8 times book value, and you look at the return equity and it's 4%, well, there's your answer. It's well below the cost of equity. This company should trade at well below book value. Okay? So think about the return equity, cost of equity, growth rate, and payout, and especially about the return equity when you kind of ask the what if questions. So let's expand out. I'm going to take a sector. I'm going to play the role of an equity research analyst. Let's see if we can use this price to book return on equity relationship to kind of gauge what's cheap and what's expensive. To do this, I'm actually going to go back in time to 2003. Then I'll show you an update from 2009 on banks, because everybody's convinced that the banking sector has now gone crazy, that you can't explain anything out there. So let's go back to simpler times where things should work better. These are European banks, 2003. Much more profitable time for banking. So these are all the banks I pulled up the numbers on. Price to book is in the second to last column. Return on equity is in the last column. If I go purely based on price to book, the bargain here is Banca di Roma, right? Trades at 60% of book value. And then you look at the return equity, and there's your reason why. Your return equity is 4.15%. That's going to be well below your cost of equity. Of course you should trade at below book value. At the other end, when you look at the companies that trade at high price to book ratios, for the most part, they are the banks with the highest returns on equity. The trick in relative valuation is looking for mismatches. You want a stock with a low price to book and a high return on equity, right? You want to avoid stocks with a high price to book and a low return on equity. Initially, I tried eyeballing this data because it's a small sample that you can start looking for mismatches. And here's what I used as my indicator variable. I looked at the average price to book and the average return on equity. I look for stocks that trade at below the average for price to book and have returns on equity above the average. Here are two companies that popped out. Deutsche Bank and DNB look cheap. Why? Because their price to book ratios are lower than the average. Their returns on equity are higher than the average. Credit Suisse and Santander look really expensive. Santander especially because they trade at price to book ratios above the average and returns on equity below the average. Don't try this if you have a sample of 100 companies. You'll start going dizzy if you start eyeballing the data. But if you have small samples, you can already start to see mismatches. The flaw, though, in what I've done is I've controlled only for return on equity, right? What am I implicitly assuming about risk and growth then when I do this? That they're all equivalent across. And you know what my fallback in 2003 would have been? And I used this line all the way through 2008. I won't use it again. Is that they're banks. They're regulated. You can't have a really crazy risky bank, can you? And then I moved on. Now, of course, I can't use that with a straight face anymore. But implicitly, that's the assumption I made when I just compared price to book to return equity, is I'm holding everything else constant. As I said, eyeballing the data can make you dizzy. So I fell back on my statistics. I have one variable that I'm trying to explain, price to book, one variable that I'm worried about, return equity. I ran the regression of price to book against return equity just for European banks. Okay? Let's read the output. 0.81, that's the base. Every 1% difference in return equity at a European bank in 2003 translated into an increase in my return equity of 0.0532. In other words, if you're a European bank with a return equity 10% higher than mine, your price to book ratio should be about 0.53 higher than mine. Is that the right number? That's not for me to say. It's a relative valuation, right? Once you've gone down this route, it's not your job to ask, is the market doing the right thing? Because if you wanted to ask that question, you should never have done a relative valuation in the first place. You should have done an intrinsic valuation. So the minute you pick the relative valuation route, you are letting the market dictate what you do, for better or for worse. Okay? So effectively here you can take, and you can use this equation then to get a predicted price to book for every bank in that group and say, these are the two cheapest banks, these are the two most expensive banks, where do I go next? You want to see what the numbers look like right now for US banks? I tried price to book, return equity. You know what? I'll tell you what my priors were before I put the scatter plot. I was convinced that there'd be no correlation between price. I was convinced that the market's gone crazy, because that's a perception. I was actually shocked when I took US banks and took price to book ratios and plotted them against returns on equity. This is every US bank, I think, with a market cap greater than $1 billion. There are quite a few that dropped below $1 billion now. Right? You know why it shocked me? What are these lines? What's the middle line there? That's my regression line. You know what the outside line is? That's with 67% confidence, the range on the. Notice something? There are 100 banks here. Not a single bank is falling outside the line. It looks chaotic, but there's order to this chaos. There's a reason banks have declined. We can say, have they fallen too much? But if you look at the relative pricing of banks, Wells Fargo versus Bank of America, there is an internal logic to what the market is doing. You might not agree with that logic, but the logic is quite there. The banks with the lower returns on equity have seen their price to book ratio. They've all dropped. All the price to book ratios have dropped, but they've dropped more for the banks with low returns on equity than high returns on equity. In fact, I'm waiting for the April updates to come because I want to kind of update this with the 2009 earnings, because that will be the ultimate test. My concern is a lot of returns on equity are going to turn negative then. And let's see what the relationship looks like. Okay? So, I mean, half the banks you're going to go work for are on that list somewhere. So you can find them. Hope they are on the right side of the line. But none of them is off the line. And the R squared, just price to book against return on equity, is 51.3%. I'll tell you something. If you're interested in relative valuation of banks, here's what I do. I download the 100 banks. I download the price to book. I download the return on equity. And I wouldn't stop there. You want to control for risk, right? What's the biggest risk you're worried about at these banks right now? Liquidity and the fact that they have these toxic assets on their balance sheets, right? If you could add an extra column that says this is the amount of toxic assets in each bank as a percentage of total assets, that might be a measure of risk. If that is the risk you're worried about. Growth, of course, is not even an issue. I wouldn't even. But if you're worried about risk, bring in the return on equity, bring in the risk, see what you can explain. Okay? Maybe you can find some incredible bargains. Maybe Wells Fargo is incredibly cheap. Okay? But take a look at the numbers before you make that judgment. Any questions? So basically, when you're looking for undervalued securities, you're looking for mismatches. Low price to book, high return equity, low risk, high growth. I mean, all 4 mismatches. If you can get 2 out of the 4, that's good. 3 out of the 4, even better. All 4, the best. You can try regressions because they allow you to capture multiple dimensions. But the graph that I showed you is actually a very effective starting point because you don't need much, right? You just need the raw data. Okay? In fact, for those of you who wonder where I got the 250 companies, I pulled them off Capital IQ. You could do the same thing yourself, which effectively means if you do this 250 company, you find it useful. If you have access to Capital IQ, you can do this every 3 months on a regular basis just to see what's happening with the overall market. And it's a good idea just to get a sense of where the market. It's good to get that picture because regressions still are not pictures, right? They're numbers. The picture of looking at what the price to book return equity relationship looks like across the market is a useful starting point for any kind of analysis. Okay? In fact, when I draw that scatter plot, price to book against return equity, I actually think about it in terms of 4 boxes. You have the companies with high price to book, high return equity. I'm not interested in those, right? Those are exactly where they're supposed to be. Companies with low price to book, low return equity, they're the losers. I don't care about those either. It's the off matrix boxes that are interesting. Here are the companies with low return equity, high price to book. Those are your overvalued stocks. Right? So take the scatter plot, draw the line, overvalued stock. Stocks in this axis here are your undervalued stocks. Kind of abstract, right? Let me show you the numbers as of January 2009. I took the 100 largest market cap stocks in the US. I put them on a scatter plot. Price to book at a point in time. Okay? Return equity from the most recent fiscal year, or the most recent the trailing 12 months return equity, which is going to be lagging because that's going to be September 2009 for these companies. Okay? So I don't think I've labeled all of them. So the R squared, just price to book return equity, 100 largest market cap stocks is 32%. That's not bad, just one variable. I haven't added anything else. Okay? Again, help me out. Where are my overvalued stocks in this graph? They're above. Let me read you the list and you tell me whether they seem to share a common characteristic. Because they do share a common characteristic, that's giving an indication that maybe it's a missing variable that you should be controlling for it. DNA, which is of course Genentech. That's a great symbol. I think one of the all-time greats. Right? What? Genentech? Beaten only by Sealy's. You seen there? ZZ. Sealy's of course makes the mattresses. That's another great symbol, right? I'd kill for symbols like those. Right? You've got about, is that Novartis NVO? Baxter, Google, is that Monsanto? I know it's not a constant theme, but it looks like a bunch of growth companies or companies with better growth prospects are showing up above the line, right? So the first indicator you're getting is, hey, maybe you're not controlling for growth. Let's look at the 2 stocks. There are only 2 that fall below the line. And I've actually found that because I've done this every year for the last 15 years, that when something falls below the line, there's usually something hanging over the stock's head, right? There's Goldman. You know what? That's good news for Goldman. You know why it's good news? That they're still on the top 100 list. No, they don't laugh. I mean, look at that. Most of the other financial service firms have dropped off the list. There's no Bank of America, no Citigroup. They're all gone. Okay. Is Bank of America still there? Oh, maybe it's dropped off by now. So that was January 2009. Goldman Sachs. But it is falling below the line, and of course, what's potentially hanging over its head is the earnings I'm using is through September 2009. And you're waiting for the other shoe to drop here, right? The other, and this is a persistent company, it always falls below the line. Every year that I've done this, is Philip Morris. And here's one of the dangers of using this regression to kind of pick stocks. If you'd picked Philip Morris 18 years ago, 18 years in a row, you'd have been below the line year after year after year. And of course, what's hanging over Philip Morris is those lawsuits and the return. What the market is saying, hey, the return equity looks great until you get a $7 billion judgment against you. So you're saying, what's the point of doing this? We're going to explain away what's falling below and above. What are these stocks again? The 100 largest market cap stocks. I would be amazed if anything came out as obviously undervalued, overvalued in this list, right? These are the most followed companies on the globe. But if I took 100 mid-cap companies or 100 small-cap companies, I will wager that you will look at a company, you will see it undervalued, you will look for reasons and you won't find any. That's the kind of company you want to invest in. I'm not saying Goldman is not a good investment, but there you have this worry. Maybe it's this. But pick smaller companies, less followed companies. And you might be surprised at something slipping through the screen, coming out, and say, I can't figure out why this company is trading at half of book value. There's nothing really pushing it down. It might be because it's the wrong sector. But with this group of companies, I'm not surprised that there are no obvious undervalued companies. But let's pick that growth. We said, one of the things we're not controlling for is growth. Is there a way I can still keep it visual? I know I can control for growth by running a regression. Is there a way I can still keep it visual and bring in growth? Three-dimensional graphs. I hate them. But they're kind of fun to draw, right? Partly because it bamboozles people. They have no idea what they're showing them. This is a box, right? Price to book, return equity, growth. I brought in the missing variable. Oh, tell me, where in this box are my bargains? It's actually not that difficult. What am I looking for? I'm looking for low price to book, high return on equity, and high growth rate. Right there, right? But again, if you're looking at the 100 largest market cap stocks, don't be surprised. But if you're looking at 100 smaller companies, who knows? You might find something in the right part of the box, pull it out, buy it, and move on. And most overvalued companies, of course, are high price to book, high return on equity, right there. Right? I want low growth, low return on equity, high price to book. Sorry, right there. Right? So cheapest, most expensive. So on a growth basis, it looks like even my bargains are disappearing, right? So it all goes the middle. There's one other variable that I'm not controlling for. So price to book, return equity, growth. What's the other variable that I should be controlling for that I seem to be ignoring? No risk. I'm treating them all as equivalent risk. And my defense might be they're all large market cap companies and they should be of equivalent risk. I might be able to get away with it, but I can't always use that fallback, right? In fact, let me show you a different scatter plot, and this was from way, way, way back that I did, and you can see the effect of risk. I took a bunch of telecom companies, took their price to book ratios and returns on equity, plotted them out, drew that line just as I did in the matrix, okay? Those are my overvalued stocks, nothing there. I said these two are not interesting. These are the high price to book, high return equity, low price to book, low return equity. Oh, there are 4 stocks here that look cheap. Let me list off these 4 stocks. These are global telecoms. The 4 stocks, and this was almost 10 years ago, that came out as looking cheap were the following: Televisas, Indus, Hong Kong, and Asia Satellite. Common theme is all emerging market telecom companies And because I'm not controlling for risk, they look cheap. So let me ask you a question. Price to book return equity, I want to control for risk. There are two ways I can control for risk. One is I can do the third dimension, right? And I end up with this mess. What's the other way I can do it? I'm sorry?
Correct the ratio.
Correct the ratio, or actually what's in my denominator? Price to book on one axis, return on equity on the other, right? Return on equity is not risk adjusted, but is there a way I can bring in risk into that x-axis? Define it as excess return. In other words, instead of taking price to book against return equity, I will take price to book against return equity minus cost of equity, which means for emerging market companies, cost of equity will be higher. You need a much higher return equity to break even. It's a simple way in which you can keep things in two dimensions. Because as I said, three dimensions are rough to work with. Two dimensions are much simpler. So if you take price to book against excess returns, you then control for risk. And if you do that in the telecom sector, the four cheap companies all go back to the line, because then you're looking at excess returns, not total returns in equity. Again, we're not doing rocket science. We're just taking the data and we're saying, what can the data tell us? Because right now, we're not using most of the data, right? We use average P and then we throw the rest of the data away. Why do we do that? There's useful information in the data. Might as well use it to extract as much as you can. So if you're going to do relative valuation, take it the distance. Don't just stop with the average or the median and throw away the rest of the information. So this is price to book, return equity beta. Again, you're looking for stocks with low price to book, high return equity, low beta. This graph, the cheapest stocks are going to be in this. Maybe this will be on your next quiz. There'll be a box and say, show me where the, just circle to where the cheapest. You know, oh my God, what is he doing? You know. But just think about it. Think about it in terms of the combination of your cheapest stock, and then look for that on the bottom and see if anything falls in there. So we've defined, we've described, we've analyzed, we've tried it in a sector, just expand to the market. Let me review again. When we did our regressions earlier, we got 28% when we used the price earnings ratio regression. We got 18% when we used the EBITDA regression. This is the price to book value regression. Look at the R squared. Remember when I showed you the price earnings regression, I said don't tar all multiples with this problem. It's not going to be every multiple that has a low R squared. It's earnings multiples that have the lowest R squares, because earnings tend to be volatile. You go to book value multiples, the R squared tends to start jumping. And when I show you revenue multiples, you're going to see the same phenomenon. Much higher R squareds, much higher proportion of the variation can be explained by fundamentals. Notice though, there are only, when you look at the variables, I've used only three variables. I've taken out payout ratio because payout ratio turned out not to be significant anymore. Okay? So don't get locked in. I have to throw. I started with 4. I ran the regression with 4. Then I looked at the T statistic for payout, and it dropped out. There's a reason it dropped out. I already have growth and return on equity in the regression, right? And if you remember your fundamentals, if you have 2 of the 3 variables, the third variable kind of pops out. So not surprisingly, payout ratio dropped out. Remember I said return on equity is a companion variable, and I said it's the most significant variable for explaining this multiple? Here's my backing for it. If you look at the T statistics, okay, 8.67, it's by far the most, at least for these 100 stocks. Oh, this is not even the market regression. Let me take that back. Market regression is coming. 8.67 is the strongest variable explaining difference in price to book ratios. So this is just 100 companies. Let me take that back. I'm going to show you the market regression in a while, but with 100 stocks, return equity is still the most significant variable. Okay? So essentially, you can try the visual picture and you can run the regression, use both to try to draw your conclusions. I can use this regression then to get predicted price to book ratios for every company in the 100. These are my 5 cheapest, these are the 5 most expensive, which effectively is what you're going to be doing on the mystery project, right? You're going to try different multiples, you're going to do whatever you need to do. Use the ultimate test, which is not which multiple would I like to use, but which multiple helps me the best in finding the cheapest and the most expensive stocks in this particular group. One nice thing about this price to book return equity relationship, as I said, if you have low price to book, you should have a low, if you have low return equity, you'll have a low price to book. High price to return equity, you'll have a high price to book. At any point in time, that's actually true, but it's also true across time. If you track a company over time and you see its return equity changing, you'll also see the price to book ratio for the company changing. Okay? I've used IBM here, but I'll suggest you do this for Goldman. Take a look at Goldman's return equity 2 years ago, 3 years ago, 4 years ago, price to book each year. You're going to see an astonishing shift as you go from 4 years ago to 3 years ago to 2 years ago to down. If you look at IBM, for instance, 1983, IBM had the second highest return on equity of the Dow 30 stocks. I mean, most people don't even remember this, but in the early 80s, IBM was the quintessential growth company. It was a company that had maintained growth for 50 years. When you wrote a case study about growth companies, IBM was a case study. Not Microsoft, not Walmart, no, IBM was a case study. It had been able to sustain growth for a very long period and have high returns on equity. So 1983, its return on equity was about 26%. Its price to book ratio was about 3.5. It had the second highest return on equity and the second highest price to book ratio in the Dow 30. The stock that was higher was Merck. Okay. In 1983, if you bought IBM for a high price to book ratio, I wouldn't have blamed you. High return on equity, it deserves a high price to book. And then you'd have spent the rest of the 80s regretting what you just did, right? Because look at what happened to the return on equity. Starting in 83, going through 93, the return on equity dropped and kept dropping and dropping and dropping. In fact, by 1983, the return on equity was a very negative number, and the price to book ratio dropped to about 1. So as the return on equity drifted down, the price to book ratio came down with it. So if you think in terms of the matrix, you can see what IBM's done, right? It started the decade with a high price to book, high return on equity. Then over the decade, it slid down to become one of your low price to book, low return on equity stocks. But even if you took IBM at its worst point, 92, 93, IBM still was the company with the most patents of any company in the world. I think Sony is second still. IBM was number 1. So even at a price to book of 1, terrible return on equity, you could look at IBM and see that that behind all this bad stuff, there was a potentially good company. You might not remember, but 1992, IBM got a new CEO. A guy called Lou Gerstner came in and he said, I'm going to turn IBM around. And you might have liked him, you might have disliked him, but he laid out a plan of action. He said, this is what I'm going to do at IBM, and this is how I'm going to change the company. And you often see this with companies, right? A bad company, a new CEO comes in, you look at the CEO and say, I think this guy can pull it off. So in 1992, you looked at IBM and say, hey, Lou Gerstner has a good plan, I think he's going to pull this off. And you bought IBM, you essentially would have ridden IBM back up to success. But if you look at the return on equity, it climbed back up to 40% by the time you get to 2000. Price to book ratio is now up to, so this is the peak of the dot-com boom. So you're at 7, 8 times book value. But you can see as the return equity improved, the price to book ratio went back up again. In fact, interesting reversal of fortune. If you look at IBM's price to book and return equity now, it's actually one of the higher numbers in the Dow 30. Because it's now again back to being one of the few companies in the Dow 30 that delivers a return equity higher than its cost of equity. Its price to book reflects it. So this linkage between price to book and return equity is not just for individual companies at a point in time. It's actually for the same company across time. So really the question we face with banks is right now the price to book ratio for banks is about 0.8 collectively. They trade at about 80% of book value, which means the market is implicitly assuming looking forward that the return on equity at banks collectively is going to be below the cost of equity. And you can see why, right? The banks, I mean, you look at banks, you look at all the toxic assets, you look at the losses coming down. But that's what the market is building in. But if you look at banks and you say, I think that's too pessimistic. I think we need banking for the long term, and the surviving banks here are going to be able to deliver returns on equity much higher than the cost of equity. There's a subset of banks you could essentially buy and ride, just as you did with IBM, ride it back. Sometimes the best time to buy a stock is when it's hit bottom. But you need a catalyst. Something has changed. For IBM, the catalyst was a new management. You want essentially some change that you can see that will cause things to reverse and move back up again. Now let me show you the market regression. I'm sorry, I kind of jumped the process. Actually, the R-squared is even higher than I told you. It's 68%. This is market regression across all stocks. And here the payout ratio actually did matter. Beta, payout ratio, growth, and return equity. Now I can back up the statement about return equity being the dominant variable when it comes to price to book ratios. You know what I'm looking at to kind of back that up? Take a look at the T statistics. T statistic for beta is about 17. T statistic for payout ratio is about 4.9, really good. T statistic for growth is about 15.9, very good. T statistic for return equity is 38. Don't even try looking for that number on a T statistic table because after 3 it stops. You're going to see this consistently. When you run a regression of a multiple, the variable, the companion variable, will constantly pop up as the highest t statistic variable. Not always, but 90%, 95% of the time. Return on equity is the dominant variable explaining differences in price-to-book ratios across stocks in the U.S. in January 2009. Across every market, return equity is the dominant. You can go look at the actual regressions on my website, the full regressions. Every single market, return on equity is the dominant variable explaining differences in price-to-book. Right? Remember we said about some markets where book values inflate. Will it work in those markets? Guess what? Companies inflate their book value. What's going to happen to the returns on equity? They're going to go down. So it's a self-correcting process. If you throw Brazilian companies and Japanese companies and US companies in the same regression, as long as you throw return on equity into the mix, you're going to be okay, because whatever one variable gives, the other variable kind of compensates. Any questions on price-to-book return on equity? So that's an equity multiple. There is an enterprise value, firm value version of this multiple. In the firm value version of this multiple, you take market value of equity plus market value of debt, and you divide by book value of equity plus book value of debt. So you're taking the value of the firm divided by the book value of the firm. What if I wanted to make this an enterprise value multiple? What do I do to the numerator to go from what I have now to enterprise value? I'm going to subtract out cash. I could take book value of equity plus book value of debt and subtract out cash as well, right? So if I subtract cash out of the numerator, I have to subtract out cash from the denominator. When I do that, I come up with a number called invested capital. A lot of buzzwords we throw around, right? Because there are small variations. The difference between book value and invested capital is book value of debt plus book value of equity. Invested capital is book value of equity plus book value of debt minus cash. When would you use one as opposed to the other? If you're going to use enterprise value in the numerator, you have to use invested capital in the denominator just to be consistent. So value to book is an enterprise value multiple. So let's look at what drives that multiple. Again, let's fall back on the template. This is an enterprise value multiple, so I'm going to use a discounted cash flow model that reflects it. Right? By now, you're getting a sense of what it is. If it's an equity multiple, you go to a dividend discount model. If it's a firm multiple, you go back to a firm valuation model. Stable growth model, free cash flow of the firm in the numerator, cost of capital minus growth rate in the denominator. Do the algebra. Once you do the algebra, at the bottom you have the value to book ratio. Remember the price to book ratio? Return on equity minus growth, cost of equity minus growth. Value to book ratio, very similar. Return on capital minus growth in the numerator, cost of capital minus growth. Okay? It actually goes back to what we did in DCF valuation. You pick up front whether you want to use equity or firm. Everything has to be defined in those terms. Equity, it's return on equity, cost of equity. Firm, it's return on capital, cost of capital. But the same logic applies. Any company that delivers a return on capital higher than its cost of capital should trade at above its book value. Any company that delivers exactly its cost of capital should trade at book value. Firm that trades, delivers less has to trade below. Malik?
So by these multiples, then it seems that you'd actually have to do some analysis of drivers of return on capital.
Yeah.
Return on investment.
In other words, remember what I said? If you're running away from discounted cash flow valuation because you don't want to get your hands dirty, because you don't want to think about excess returns, because it is a lot of work, right? We have to think about excess returns to get the growth rates, to get the DCF valuation. If you're using multiples, do it for the right reason. Don't do it because it's less work and you don't have to understand the companies, because it's a terrible reason to pick multiples. You're then avoiding the issue, right? If the fundamentals matter with intrinsic value, do you think they're going to stop mattering just because you decide to use PE ratios, EV to EBITDA, or price to book? The same fundamentals still. The only choice you have is, do you want to act like they don't exist, which is what a lot of equity research analysts do, or do you want to confront them head first? The only problem is people like to use multiples because they're simple, right? And this does make the process more complex again. But there is a price to simplicity here. If you just pick based on PE ratios, EV to EBITDA, you are going to end up picking the wrong companies. You have to at least ask the follow-up questions to get a sense of what's cheap and what's expensive. So that's the bad news. There is no easy way to value companies. So if you're looking for a rule of thumb that's going to work, my suggestion is abandon that thought. It's not going to work. There's going to be no one multiple of EBITDA, no one multiple of earnings, no one multiple of sales that's going to apply across companies. So let's try this out. Let's take a hypothetical company. Company has a return on capital of 12%, cost of capital of 10%, growth rate of 5%. Okay, let's use the equation. Return on capital minus cost of capital, growth. So in this case, we can already see, because capital is above the cost of capital, the value to book ratio is going to be above 1.4. That number, though, is very sensitive to that return on capital number. If that return on capital drops to the cost of capital or below it, you should expect to see the value to book ratio reflect that. Okay? And in fact, that's what this graph shows. Basically, it shows you what will happen to the value to book ratio as a function of the excess return. This is what I suggest with the price to book return equity. Rather than look at return equity, look at return equity minus cost of equity, because that's what drives the process. The place where they all cross, of course, is where their excess returns are 0. But as you go across, you can see the value to book, price to book will diverge. And the higher your excess returns are, the higher the multiple of book value you're going to be trading at. Book value multiples are all a function of excess return. Equity multiples of excess equity returns, firm value multiples of excess return on capital. Okay. Any questions on the multiple? So I might as well run the regression. I'm going to save you the sector because by now you can see what the sectors are going to look like. R squared, not as good as the price to book. Actually, I always have a tougher time explaining differences in value to book ratios than price to book. So the dependent variable here is value of equity plus value of debt minus cash. Denominator is invested capital. The independent variables are used for expected growth and revenues. Again, note I've switched back to revenue growth because it's a firm multiple. Market debt to capital as a proxy for risk and return on capital. And the T statistics again reflect return on capital is by far the dominant variable explaining differences in value to book ratios. Any questions on book multiple? I still can't get equation in Microsoft to change the font color. I've tried everything. So if any of you figure this out, try it. And I spent half an hour this morning trying to get this, see this equation here, to be white. It won't work. Because usually if you do have a graph, you can change the font color. So if you guys figure out how to do it, let me know. So last multiple I want to talk about is revenue multiples. I'm going to start off with the multiple that you're more likely to see, which is the price to sales ratio. But we've already said it's not consistently defined, right? Numerator is an equity value, denominator is revenues. In fact, the more consistent version of this multiple, instead of using market value of equity in the numerator, what should I use instead? Revenue belong to not just the equity investors, the whole. So instead of market value of equity, I should be market value of equity plus debt minus cash. See why I need to be minus cash? Because the income from cash is not part of revenue, so it should be enterprise value to sales. But this is the multiple you're more likely to see, price to sales. Okay. Anthony?
No. We don't correct for cash in the book value when we just did that.
I'm sorry?
Why didn't you correct for cash in the last
I showed you two versions of that multiple, I think. Say, if you're doing total book capital in the denominator, then you have to leave cash, because cash is part of book value of equity. So if you want to correct for cash in the numerator, you have to correct for cash in the denominator as well. So the reason book value is a little messier is you're talking about book value coming off the balance sheet. Balance sheet cash is treated as an asset, so unless you explicitly subtract it from book value, it's going to be in there. So that's why for book value multiples, at least you don't worry about cash as much, because you can leave it in there or take it out. You just have to do it consistently. Okay. So price to sales is an inconsistent multiple, but it's used all the time. Okay. So let me show you both the price to sales ratio and the EV to sales ratio, because they're, those are the two. The price to sales ratio is the blue. The EV to sales is the red. The price to sales ratios are always going to be lower than the EV to sales. Do you see why? Maybe let me take that back. Not always, but most of the time they're going to be lower. When will they be higher? When will the price to sales ratio for a company be higher than the EV to sales ratio? Because EV should be higher, right? It's value of equity plus debt minus cash. You take a technology firm, take Apple, right? Market cap of about 100 billion. How much debt does it have? 0. Cash of 20 billion, right? Which gives you enterprise value of 100 plus 0 minus 20. So the price to sales will have 100 over the sales. The enterprise value to sales will have 80 over the same cash. Okay? So it's unusual, but for companies with a lot of cash, which have cash that exceeds debt, you can actually get EV to sales ratios that are lower than price to sales ratios. Okay? But for most companies, the reverse is going to be true because you add debt and subtract out cash, you get a higher number in the numerator. Notice a difference between this distribution and every other multiple we looked at. It's more spread out, right? Unlike price earnings or price to book, which has a very, very skewed distribution, price to sales is spread out much more. It's the nature of price to sales. It varies much more widely across sectors. It's much more difficult to have a rule of thumb. With price to book, if you ask me for one number, you know what I'm going to say right now, 1.01. That's a median price to book. So if you use it for a company, you're not going to be off too much. With sales multiples, if you ask me for a rule of thumb, I will refuse to give you a number because it really will vary across sectors. It will vary across companies, even within the same sector, much more widely than any other multiple out there. Which, of course, raises the follow-up question. What causes it to vary? Let's do the algebra again. Price to sales, equity multiple, right? Price to sales ratio, I'm going to go back to dividend discount model. You plug in the numbers. You get the variables that drive the price to sales ratio. The price to sales ratio for a company is a function of 4 variables. When I list the first 3, they should be very familiar. Cost of equity, growth rate, payout ratio. Exactly the same 3 that showed up with price earnings, price to book. In fact, I'll save you the trouble. If you have any equity multiple, those 3 variables are always going to be there to start the process. Is the 4th variable that just popped up? The companion variable for price to sales ratios is the net profit margin. Or put another way, when I said this stock is cheap, it's trading at a market value that's 1/3 of its revenues, the first question you should ask me is, what is the net profit margin? The lower that number, the lower the price to sales ratio is going to be. The higher that number, the higher the price to sales ratio is going to be. In fact, if I expand it out, 2-stage models, variables stay the same. Payout ratio, cost of equity, growth rate, net profit margin, the high growth phase, net profit margin, the stable growth phase. It really adds nothing to us. This is why I didn't do it for every other multiple. Having 2 phases, 3 phases, 4 phases, 5 phases in your model doesn't change what drives the multiple. It just means you've got to estimate the variables 3 times, 4 times, 5 times as you go through the process. And I'm done with all of the multiples. I'll give you a table with all the multiples and the companion variables and the variables I have to look for. But don't use that as a black box, because if you didn't have, if I gave you just the first column, you should be able to fill out the rest, because all it is 2 equations, right? The dividend discount model for equity multiples and a firm valuation model for firm multiples. With those 2 equations and a little algebra, you should be able to fill out every single box in that. And that, I think, is 90% of relative valuation, isolating the companion variable, figuring out the questions to ask as what-if questions. Every class you have in your MBA program is, in a sense, feeding into some number in this valuation, right? In fact, I don't know whether this is still a common, you a price leader or a volume leader. You can go for low margins and high turnover ratios, high margins and low turnover ratios. Let's frame this in terms of price to sales ratios. If you think about what the growth rate of a company is in equity terms, it's retention ratio times return equity. Return equity itself can be broken up into 2 components. Net profit margin times the turnover ratio. Turnover ratio being, for every dollar of equity, how much revenue do you create? Put another way, there are 2 ways to glory here. One is you can have really tiny margins and pump up your revenues. That's a Walmart route, right? Walmart doesn't make much per item sold, but it sells a huge number. Its turnover ratio is really high. The other road to glory is to go for really high margins, the Tiffany route, and not try to sell that much. Is one better than the other? Or if you're a company and trying to decide which route should I take, this isn't something where you have to sit there and discuss it, because on the one hand and the other hand, just plug them through. Whichever one delivers the highest value to you is the better one to choose, right? So plug in the low margin, the high turnover ratio, the high margin, the low turnover ratio. One of them is going to pay off as a higher price to sales ratio. That's your superior approach. In other words, you can take marketing strategies, brand name strategies, pass them through this test to see which ones will deliver the highest impact for you. It's the ultimate bottom line, right? Because it looks at the numbers and looks at the effect on value. Okay. So here's a final example of price to sales. I took that high growth company we've been working with, 5 years of high growth, and I broke down the return equity into net margin and sales to book equity. So looking at where the return equity is coming from. Put in a beta of 1.25 during the high growth phase, saying if you're high growth, you're risky as well, and put in a payout ratio of 20%. Your expected growth rate for the first 5 years is going to be the 10% net margin times 2.5, that's a 25% return on equity, times the 80% retention ratio, which gives me a growth rate of 20%. So my margin, my turnover ratio, and my retention ratio all feed into my growth rate. In stable growth, I knock the growth down to 6%. I'm sorry, no, knock the growth down to, 6%. I also knock the net margin down to 6%, saying you're probably not going to be that profitable forever. Sales to book stays at 2.5, but 2.5 times 6% means my return on equity has dropped to 15% in stable growth. So it all ties together. The same fundamentals holding things tie together. Price to sales ratio for this company, given those specific characteristics, is 1.06. So it should trade at 106% of revenues. Why? Because it has great margins. That by itself, as I said, is not the interesting number. If I asked you what will happen to this company if margins come under assault, there's all this talk right now about how brand name companies are feeling the pinch, which essentially is another way of saying their margins are going to come down. If margins decrease here, no surprises. Price to sales ratio is going to decline as well. It's going to go from 1 to 0.8 to 0.6 to 0.4. The key number at many consumers, you keep your eyes on the margin. That margin starts dropping. Expect to see the price to sales ratios drop as well. Okay. So when you look at revenue multiples, the key number that's going to drive revenue multiples is what you think margins will be. Okay. Last thing for today. I know you're tired. Let's take this and apply this to grocery stores. Okay. These are price to sales ratios for grocery stores. The reason I pick grocery stores, they're pretty boring for the most part. But I'm going to take you back a couple of years. And when you look at this list, you're going to very quickly see the outlier pop out at you. Okay? So this is a list from January 2007. The grocery stores, price to sales ratio, net margin. I'm sorry, it got thrown off a little bit. Okay? Company the highest price to sales ratio by far in January 2007 was Whole Foods, which is a very unconventional grocery store because it had high margins. It was able to deliver those high margins. Okay? You look at that, basically, if you look based purely on price to sales ratios, Whole Foods looks way off the map, but it does have a counterfactor, which is it has high margins as well. Okay? I actually graphed it, and you can see how much of an outlier it is, right? If I drew a regression line through grocery stores, there's Whole Foods right there by itself. And of course, we looked at equity research reports in 2007. You know what the story they told was. High growth, the high margins, therefore it's okay for Whole Foods to be way out there. But after controlling for margins, you still have a company that looks massively overvalued, right? I wish I'd sold short on Whole Foods right after this. Because for those of you who've tracked Whole Foods, it's had a pretty rough last year. I actually looked at Whole Foods, the grocery business, a couple of months ago. Notice something interesting? Whole Foods is now below the line. It's actually gone from being vastly overvalued to actually slightly undervalued. This is what you're hoping for with these regressions, right? Because you make money not based on where a stock falls in the regression, but where it moves to the next time you look. You want those stocks above the line to drop to the line, the stocks below the line to move up to the line. Not every story has this happy ending. As I said with Philip Morris, you'd be sitting there looking at the stock being undervalued year after year after year. But that is partly what you're looking for when you look for undervalued and overvalued stocks, is that movement back towards where you think the stock should be. Okay? Let's stop there. When we start off, we'll start with the EV to sales and brand name valuation next session.